Hello, let we discuss about Chapter 3, Audit Risk, Materiality and Sampling. We are Ding Lan Yai, Patricia Henry, and Stephanie Beatty. First of all, let we introduce to all of you what is auditing about. The main objective of auditing is to enable auditor to express an opinion whether the financial statements are prepared in all material aspects in accordance to financial reporting framework. This objective can be reached by identify specific audit objective for each class of transaction and account balance. There are 7 management financial statement assertions, of which some of these assertions applicable to account balance, some to class of transactions balance and others to both account balances and transactions. In the account balance, there are existence, rights and obligations and valuations. While in the class of transactions balance, there is only one management assertion, which is occurrence. And in both of account balance and transactions, there are completeness, measurement and disclosure. Existence. Assets and liabilities of the entity exist at a given date. Rights and obligations. Assets are right of the entity and liability is the obligations of the entity at specific date. Valuations. Assets and liabilities are recorded at appropriate carrying value. Occurrence. Recorded transactions or other events occurred during the relevant period and pertain to the entity. Completeness. There are no unrecorded assets, liabilities, and transactions. Measurement. A transaction is recorded at the proper amount and revenue and expenditure is allocated to the proper period. Disclosure. Particular components of the financial statements are properly disclosed, classified and described. Concept of audit risk. In risk of auditing, auditors may accept some level of uncertainty in performing audit function. The risk happens when the financial statements are materially misstated, which can cause the auditor to give inappropriate opinion. Therefore, auditor should plan and perform the audit to reduce audit risk to an acceptable low level, and reduce the uncertainty to a tolerable level through adequate planning, supervision and conduct of audit in accordance with approved auditing standards and firm's quality control policies. Audit risks are categorized into 3 risks, which are inherent risk, control risk and detection risk. Inherent risk. This risk exists within organization that may cause the misstatements of financial statement. It relating to the characteristic of the business. Inherent risk can be considered at 2 levels, which are at the financial statement level, such as nature of the client's business, size and number of location of the company. While at the account balance and transaction level, can be result of previous audit and non-routine transactions. Control risk. This risk that the client's internal control system would not prevented or detected and corrected such material misstatements. Auditor's responsibility is to obtain understanding of the internal control system of the company. However, internal control system cannot provide management with conclusive assurance because inherent limitations, which are cost-benefit analysis, means sometimes cost to set up internal control is too high. While inhuman error can be done due to carelessness, ignorance and rejection to adhere to the system, misunderstandings of instructions. Next is collusion of management or employee and changes in conditions and environment. Control risk can be considered at 2 levels, which are at the general level, which auditor should consider attitude of management towards the important control system, and at the specific level, where auditor should consider and evaluate whether existing control procedures is good enough to prevent and detect errors or not. Detection risk. This risk that any remaining material misstatement will not be detected by the auditors. They should be able to decide what level of detection risk will bring the audit risk to acceptably low level. The auditor's responsibility to design audit procedures that will be provided reasonable assurance that any material misstatement will be detected and removed from the financial statements. The audit procedures to carry out are substantive test and analytical review procedures. Relationship of materiality and audit risk. There is an inverse relationship between materiality and audit risk. The lower materiality level, the higher audit risk, and vice versa. Auditors take into account the inverse relationship between materiality and audit risk when determining the nature, timing and extent of audit procedures.
Materiality is an auditor's preliminary estimates of the smallest amount of misstatement that could be material to the client financial statement. Information is material if the misstatements could influence the economic decisions of users taken on basis of financial statement. It is the criteria used by accountants and auditors in order to differentiate between crucial matters and unimportant matters. The auditor should bring the matters to client attention, to give a true and fair view opinion on financial statement, if the material misstatements exist. Next, concept of materiality. The financial statements may contain misstatements but not so large. Understanding allows auditors to use sampling techniques, therefore could be completed on reasonable cost. Fraud and errors are the sources of misstatements. Material misstatement is the material amount of misstatement and any failure to comply with the Companies Act 2016 requirement. In determining material misstatement, quantitative and qualitative measures should be considered. Relative concept rather than absolute. For example, a misstatement of RM 1 million would be material for a small company but may not for a large company. Bases are needed for evaluating materiality. Net sales and total assets are normally used as primary base. A misstatement of RM 100,000 would be material. The materiality threshold can be expressed on bases selected rather than absolute amount. The quantitative guideline. There is no official guidelines on quantitative measures of materiality. This is the table, in which it states all the bases used in measuring materiality, and also the materiality threshold, which stated in terms of percentage. In terms of qualitative factors, it can also affect materiality. Certain types of misstatements are important even if the dollar amounts are small. For examples, misstatement could be material when there is amount involving fraud considered more important than error and if bad consequences arising from contractual obligations. Moreover, if it affects a trend in earning, then misstatement could be material too, and also the misstatements that are immaterial but still need to disclose to comply disclosure requirement. However, no specific rules is provided in determining materiality. It requires professional judgment by practitioners. For the policy statement, which is materiality guidelines, for an example, professional judgment is to be used at all times in setting and applying guideline. The combined total of misstatement, which exceed 10% is material. But, if it less than 5%, it is immaterial, and if it between 5% and 10%, it requires professional judgment to determine their materiality. The 5% to 10% must be measured in relation to the appropriate base. The recommendations in selecting the appropriate base are in terms of income statement and balance sheet. In income statement, the combined misstatements are measured at 5% to 10% of profit before tax, depends on the size of income. While, in balance sheet, the combined misstatements should originally be measured for current assets and current liabilities, which are 5% and 10%, and for total assets are in between 3% to 6%. Next, is a sampling. Audit sampling is the process of applying procedures to less than 100% of items within an account balances or class of transactions such that all the sampling units have an equal chance of selection. This is enable the auditor to obtain and evaluate audit evidence about some characteristics of the items selected. There are two types of audit sampling, first statistical sampling and second non-statistical sampling. Statistical sampling is an approach that using random selection of sample. It is use probability theory to evaluate the sample results. Statistical sampling also allows auditor to rely on a smaller sample for intensive checking. Non-statistical sampling is an approach that uses non-random selection methods. It needs more subjectivity in making sampling decisions. The auditor must rely on his professional judgment in making decisions such as choose and evaluate the sample. Then, auditor will select the sample item that gives useful information. There are three categories of statistical sampling. First, attribute sampling. Second, monetary sampling. Third, classical variable sampling. Attribute sampling is a sampling approach that used to estimate the proportion of a population that possesses a specified characteristics. The most common use is for test of control, where auditor wants to determine the deviation rate for control implemented in accounting system and internal control structure. For example, auditor do examination on how frequent a credit check is not performed on customer orders before delivery the good or before approve another credit sales. Monetary unit sampling is an techniques that uses attribute sampling theory and techniques to estimate the amount of misstatement for organization account balances. It is designed primarily to test for overstatement errors in the sample. It expresses a conclusion in monetary amounts rather than as a rate of occurrence. As an example, auditing accounts receivable, loans and inventory. Classical variable sampling is an approach that uses normal distribution theory to evaluate the characteristics of a population based on the sample data. It is used to determine the range of the data when selecting the sample based on random table computer audit software. For example, checking, evaluating and auditing account receivable in which a large amount of misstatement is expected. There are a few advantages of statistical sampling. It helps auditors to design an efficient sample, helping the auditor and measure the sufficiency of evidence obtained. Permit the auditor to do more intensive examination of sample items with rely on smaller sample sizes. Statistical sampling also has disadvantages. For training auditor in the proper use of sampling approach will involve additional cost. In terms of software for design and conduct the sampling application, the firm will need additional cost to buy the software. Next, the advantages of non-statistical sampling. Auditor using non-statistical sampling because has a lower training cost of non-statistical sampling. It is easy to implement it and proposed adjustment based on quantitative analysis. For disadvantages of non-statistical sampling, there are no systematic ways which make the user feel the training is difficult to study and apply it. It also no consistency and uniformity because non-statistical sampling based on professional judgment of auditor. It will changes follow the situations. Moreover, it may cause wrong evaluation of sampling risk which get different results from examination carried out. There are similarities between statistical and non-statistical sampling in terms of steps of audit sampling. Firstly, planning the sample where auditor design the audit test to reduce sampling error. Secondly, selecting the sample where involves select the sample items. All sampling unit in population has chance to be selected. Thirdly, performing the audit procedure to meet the audit objectives. Lastly, evaluating the sample. This involves error analysis, projection of the error and draw a final conclusion. Differences between statistical and non-statistical sampling. For statistical sampling, auditor should have knowledge on statistical formula, but for non-statistical sampling, auditor make judgment based on experience and common sense. Next, statistical sampling more to objective results. The sample are mathematically proven to represent population. For non-statistical sampling, it is more to subjective result where the sample may not represent population. For statistical sampling, different auditor with the same approach will give same results. However, for non-statistical sampling different auditor will have different approach and also lead to give different result. Next, statistical sampling is an efficient method and can delegate the responsibility to select audit sample to lower-level audit staff. But, not an efficient method for non-statistical sampling. It need more senior audit staff to devise and choose the sample. There are common steps of application of sampling on audit tests whether for statistical or non-statistical sampling. First, planning or designing the sample. Second, selecting the sample. Third, testing the sample. Last, evaluating the results. First step, planning the sample. When designing an audit sample, the auditor should consider the objectives of the audit procedure and the attributes of the population from which the sample will be drawn. This is important to ensure that all, and only, those conditions that are relevant to the objectives of the audit procedure are included in the projection of errors. There are involves following steps in planning the sample. First, determine the objective of the test. Auditor need to consider specific objective to be achieved and the audit procedures to be performed towards this objective. Second, define what errors or deviations are being sought. Auditor need to consider the factors that constitute the error by referring the objective of the test. Third, identify the population and sampling unit. Auditor must be very careful to identify the population and sampling unit. Decide whether the population needs a subdiving into subpopulation or not, known as stratified the sampling. The objective is to focus greater audit work on areas that are of high inherent risk or potentially materially misstated. 4. Stratification of population. The process of dividing a population into subpopulations, each of which is a group of sampling units which have similar characteristics. 5. Decide the sample size. Auditor main concern is to reduce sampling risk to an acceptable low level. The larger the sample selected, the more representative of the population it is likely to be. Second step, selecting the sample. The sample that need to be selected is the sample that can be predicted to represent the population. All the items have an equal chance to be selected. There are 3 methods of selecting the sample that are random sample, systematic sample and haphazard sample. Generally, random sample is considered as the best method of obtaining a sample. A computerized or random number table is used to generate the random numbers to tests. The advantage using a random sample is to not allow the auditor to be biased, which will affect the selection of the sample. Systematic selection is a situation where the auditor determines a sampling interval by dividing the physical population by the sample size. For example, sample size is 15, and having determined a starting point within the first 3, each third sampling unit thereafter will be selected. Even though the starting point is may be determined haphazard, but the sample more likely to be random if it is determined by a computerized or random number tables. Haphazard sample is a method which selection of a sample without a specific reason or structured technique. It is useful for non-statistical sampling but not really recommended. This is because tend to be biased. This method is not appropriate when auditor using statistical sampling because the auditor cannot measure the probability of an item being selected. Third step, testing the sample. Auditor will perform audit procedure appropriate with the audit objective on each item that's selected. Due to void, the ample selected is not appropriate. If a selected item is not appropriate, the audit procedure need to be performed on a replacement item. As an example, a voided check may be choose when testing for evidence of payment authorization. If the auditor satisfied the check had been properly voided, thus it did not need constitute but another sample need to choose. Last step, evaluating the sample. Each error discovered will need to be examined for its implication. An error that consistent with expectations during the planning stage can be projected to have an impact on the population. Analyze nature and cause of error. Before drawing final conclusions about the population, the auditor should consider the qualitative aspect of error. Projecting the error. Auditor projects the sample result to the population tested and compares these results with the minimum error he willing to accept. Draw final conclusion. Auditor should evaluate the sample result to determine whether their assessment of population is confirmed or needs to be revised. When the results indicate error due to ineffective internal control or balance materially misstated, auditor should request management to investigate identified error, make any necessary adjustments or modify the nature, timing and extent of further audit procedures. That's all. Thank you for watching.